In this week's update, Trump's agenda causing market mayhem. Many short-term moves have absolutely no meaning. The benefits of an open mind and confirmation, and the absence of clarity about process this market will skin you alive. My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Another fascinating week. It seems like we've got this rolling agenda of uncertainty that is just pervading everything. So let's have a bit of a reality check on what happened in another reasonably tumultuous week. So you could argue, are we in a new normal or are things still the same? So the new normal is that tariff policies are causing gross uncertainty. That's an understatement, that's for sure. And you would have been excused for thinking a couple of weeks ago that the conclusion of tariff deals would have brought this sideshow to an end, but it actually hasn't, because Trump is still flipping and flopping backwards and forwards. So we've still got a tremendous amount of uncertainty, but markets just seem to have got tired of it. They're not too worried about the backwards and forwards with tariff policy. But when you add in leverage and the algorithmic trading, it just really amplifies what's going on. And you might recall from last Sunday, it really looked like the market was giving signals that we were at some sort of significant top for at least a short period. But of course, that all changed immediately, and I want to step through what happened last week day by day. And the other big issue, which perhaps is not getting the media attention that it should, is just all this uncertainty and the impacts it's going to be having on supply chains. And it just has to. You can't have this level of uncertainty where companies and governments can't really plan for the future because they just don't know what it's going to look like. So we end up with an absolutely dog's breakfast full of uncertainties, which if you're an inexperienced stock market investor, is a real trap. It really is. I can't remember an environment where the circumstances are more uncertain. So if you've not got experience and you don't understand that there's not necessarily a whole bunch of drivers that are not obvious causing prices to move, then it's really very difficult to navigate. And then, of course, we've still got some of the old normal. The old normal is that stocks in America, anyway, just kept advancing, and in Australia at the index level. Index level set new highs. And it's driven by what stock markets should be driven by, and that's just good old-fashioned earnings growth. And we're getting that in parts in both America and in Australia, but it's not universal. The indices are rising because the large cap stocks, or some of the large cap stocks, are rising, particularly in that technology area. But when you get away from the top 20 or 50 stocks in Australia, there are a lot of differences in the way that the market is treating these earnings results. And there's some very good, some exceptionally good, and there's also some bad and ugly as well. So the old normal is still there. But look, the earnings season is starting to draw to a close in the US, and 81% of the S&P stocks that have reported so far have beaten earnings estimates. And that's the highest rate in 2 years. So when you've got that fundamental driver of stock market prices, then it's no wonder that the market is setting new highs. It's just the potential uncertainties around tariffs and the reality of the impacts that are eventually going to filter through just aren't being acknowledged and priced in at the moment. And that's a bit of the danger in the market. When you look at some of the US fundamentals, they're really quite scary, and I covered some of this last week. It's easy to write a shopping list of all the things that could go wrong, and you just go and bury your head in the sand. They really are very scary. But as often happens, fundamentals don't translate to the same sort of logical price movements. And so we've got this situation where you can't just draw the logical conclusion and make decisions on that. These are just a couple of the big picture issues. The debt in the US has spiraled to $37 trillion. It's rising so quickly that I'm not sure that that's even the right up-to-date number, but it's 37 trillion or thereabouts, and it's accelerating. So that is not a good situation. On top of that, we've got the housing market is in the doldrums in America, and loan delinquencies are rising. Now, whether that gets us back to a situation something like what preceded 2008 and the GFC remains to be seen. There's not the same level of financial engineering that was going on back then, but certainly on the ground, there are some real negative effects in the US housing market. It's not a bust yet, but the trends certainly are troubling. So that is one to watch. And again, that's not getting very much coverage in the media. Economic growth in America is still okay, but it's slowing. And tariffs certainly can't be helping that. Now, offsetting that on the positive side, we've got real strength in the indices, in the S&P and the NASDAQ. And that means that you've got very buoyant sentiment. And that buoyant sentiment pervades the rest of the market. It goes all the way down the food chain. So that's setting the fundamental backdrop for the US market. And then when you add in on top of that, the 81% beat rate and the preparedness of the market to just turn a bit of a blind eye to the traditional valuation metrics, explains how we get what we get, which is new highs in the NASDAQ last week and the S&P trading within a whisker of its all-time highs. Now, I'm sure you've heard in the past that whenever you hear someone say that there's a new normal because of XYZ circumstances, that's a bit of a trap. And that may well be the case again this time. So that's just something to stay mindful of in terms of perspective. All right, let's go and look at some of the charts. Just before I do that, just a reminder that this is general advice only, and you need to make sure that you're getting the wider investment and financial and legal advice that you need before you take action. All right, let's just quickly look at the American stocks summary first, and then we'll go and look at the charts. So the S&P put on 2.4% for the week, the NASDAQ almost 4%. And recall last Sunday I was talking about the significant plunge that we'd seen on Thursday and Friday of the week before, and how the probability of that playing out to being some sort of peak and then some sort of period of either consolidation or more downside was really quite high. Well, that immediately turned around, of course, and the indices went straight back up again. And the Russell 2000 for small caps, it went up 2.4%. So there certainly is still a very broad nature to this rally. And it's just as well that we deal in probabilities, or we should deal only in probabilities, because that's what I was talking about last week. And let's go to the charts and see what that looked like. So this is the NASDAQ composite, and this is where we stood after the Friday of the previous week. So that is Friday, the 1st of August. So we had a gap higher on Thursday. We then traded down with a much longer range candle. That's a pretty decent reversal in sentiment. And then we got a huge gap into Friday and it traded down. Didn't trade right on its lows. There was a little bit of support there, which was perhaps the first indication that the buyers weren't completely kicked out of the room. But that was where we sat the Friday before last. And so 9 times out of 10, that pattern would lead to something like what we got here, because it's an abrupt change of sentiment. You look at what these candles indicate about sentiment, and even on the open of Thursday, the 31st of July, sentiment is still very buoyant to gap up. It has to be. But then within the space of one session, it all changes. Well, let's look at what happened after that. So we then got a gap higher and reversed back up again as though Friday was a complete non-event. Bit of economic data caused the market just to pause a bit on Tuesday, but then after that, we had real strength on Wednesday, strength again on Thursday because we got a gap higher. That means that the buyers are just falling over themselves to pay up to get in the next day. And then Friday, of course, finished the week off with another close right on the highs, new all-time closing high as well. So this is one of the 1 in 10s where that sort of pattern doesn't play out the way that you would expect. And that's the reason that you should never form a definitive opinion about what the market is doing. You just deal in probabilities. And if the market decides to immediately turn back up again, then your actions have got to be able to accommodate that. Now, this is interesting too. This is the NASDAQ versus the S&P, and you can see we're clearly on a strong short-term uptrend in this ratio. That means that growth stocks are tending to outperform the more defensive parts of the market. SMH, Semiconductor Index on a weekly chart, sets new all-time highs as well, so that's looking really robust. If we go into the sector-by-sector basis, technology still leading. Interestingly, XLP, which is consumer staples, has picked up quite a lot in the last 2 or 3 weeks. So that's very significant. And it's indicating that maybe underneath the surface, there is a bit of defensive thinking going on in the US market. And in Australia, we've still got energy leading the way, which is a lot about some specific short-term influences. And then we've got information technology and then healthcare in that order in the Australian market. So not a lot of change there. The S&P on a daily chart looks very similar to the NASDAQ, just not quite as robust a move to the upside. And that's the equal weight S&P, and finally the NASDAQ on a weekly chart. So that's where we sit with the US market in terms of currencies. The US dollar was net down on the week, and it's really hard to know where this is going to go, but I suspect the more dovish Fed that we're going to have when Trump eventually gets his way and Powell gets removed and Trump appointee gets put in there, I suspect will put downward pressure on the US dollar. The Aussie dollar finished the week up a little bit. So just reflecting what happened with the US dollar, really 64.5. So just summarising then, the US dollar index at 98, the 10-year yield was at 4.29, so it moved up a little bit. And the VIX, which had gone up to 20 the Friday before last, collapsed back down to 15. So there certainly is a healthy level of complacency, if I can put it that way, in the US market. Aussie Stocks, 64.5 was where our dollar finished. An August rate cut looks highly likely. Inflation is sort of moderating a little bit in Australia, so I think it would be a major surprise if the RBA does not cut this month. The consensus through to the end of the year is for the Australian dollar to stay in the range of 65 to 67 cents. That's where the betting markets are. But a key driver for the Australian dollar, of course, apart from the US dollar, is commodity price strength across iron ore, rare earths, lithium, etc. Now, our index managed to rise 1.67% for the week. There was a correction that looked likely as a follow-on from what had happened in the US, and from memory last Sunday I said that I expected the Australian market to open very weak and have a pretty poor day on Monday. Didn't happen. The Australian market response on Monday was very mild, and that was the first indication that the US market was not going to perhaps have the follow-through that had been indicated. It was a week wherein I've got our own reporting season. It was a week of very large price moves in both directions. There were plenty of 15, 20, even 30% moves in companies in Australia of some substance in both directions. So that was the week that was the Australian market. There is still some very exciting opportunities. There really are, whether we end up with some sort of corrective phase in the near term or not. I think there's a bunch of stocks that are just going to keep moving up anyway because the fundamentals and the earnings really justify it. Precious metals, gold was up $35 to almost $3,400. And in Australian dollars, we're back over 5,200 again. Silver had a good week, up to 38.34. There is confusion around exemptions on Swiss gold from these reciprocal tariffs. What are they going to do with various forms of gold? There is talk that there'll be tariffs on 1 kilo bars of gold. It's really impossible to anticipate where this is all going to finish. But the policy is creating a bit of a two-tiered market structure, and I don't think anyone has any confidence about where we go. Gold stocks, GDX added 12.3%, so this is the Australian listed ETF, 12.3% for the week, which is a very, very strong week. But many gold stocks did a lot better than that. So the gold market really starting to get the motor running now in Australia. So let's go and look at the gold market. We'll start first of all with the silver. So this is silver on a daily chart. I'll just swap that to a weekly. And you can see we've had 3 of the last 6 weeks have been really strong and net moving to the upside. So clearly we've broken out above this key level at 35 and moving ahead. We've got some overhead resistance coming in around about 44 and then the all-time highs just under 50. But you look at that chart and you can see that silver is trending very strongly. This is the US dollar gold price on a daily chart, and we're still in this consolidation zone between, it's actually got some inclined nature to it. So we've got a flat top, an inclined base. So one would think that the odds favour eventually we'll get a breakout above this sort of 3450, 3500 level. So that looks to be a high probability looming event. In Australian dollars, it's really just been going sideways and we haven't really made any ground. You've got to go back to April when the trend sort of started to plateau. And finally, while I'm here, this is Bitcoin had a significant dip. And again, I was talking about this the previous Sunday, but we did have quite a decent rebound and right off that key support level. So Bitcoin, 116,700, and that strong support is still holding. Other commodities, copper was at 446 after it got smashed back down again due to all the tariffs, backwards and forwards. The exclusion of refined copper has triggered a collapse in the premium on the COMEX exchange, so it was up closer to $6, and then it's collapsed down to around $4.50. We've still got tariff policy risk. Whilst we thought that once the tariff deals were done, that would be it and Trump would move his focus onto other things, but it seems not. So that is still a big risk for the copper sector. West Texas Intermediate crude was down to 63.35. And it's really hard to know what's going on in that oil market. We've got OPEC doing its thing, and we've got Trump doing his thing with sanctions and particularly trying to get it at Russian oil. It's a very, very difficult sector. So move on. There's the spot copper chart. You can see the huge plunge a couple of weeks ago when that tariff clarification came through. And there's crude oil also falling back down towards the bottom of that range. So wrapping things up, the dilemma that investors face at the moment is that we've got, on the fundamental side, we've got a litany of really troubling economics. It's very easy to construct a long, long list of things that could go wrong. But offsetting that, we've got just some amazing growth stories and we've got some unstoppable megatrends, and the impact of defence spending at much, much higher levels, the impact of AI and everything that will go with that. These are just unstoppable megatrends. And I think in those sectors, they are creating perhaps a new normal. Now, valuations will get ahead of themselves, as they always do, because that's just the animal spirits. That's the way that people's psychology behaves in the market. But make no mistake, those mega trends are here to stay. And for some companies, they will fuel enormous share price gains because the growth and the earnings will be there to justify them. So that is the tricky bit for investors. So stock selection becomes critical. You really only want to focus on the best of the best. And there's no reason to accept second best because there are so many, if you're an Australian-only investor, there are so many great stocks that have got highly probable high growth assets that you just don't need to accept also rans. This idea of diversification for diversification's sake, just to spread risk, is complete nuts, in my view. Just find the best of the best. They're not that difficult to find. The harder part is having a process and the confidence to stick with them when the market gets volatile. That's the difficult bit. Finding the best of the best targets is a reasonably straightforward exercise. So understanding your process and understanding what you need out of the market and are prepared to tolerate out of the market has never been more important. Portfolio analyst last week was taking stock, which we do the first Tuesday of each month, looking back at the prior month. There was a particular focus on lithium and rare earths in that edition. Okay, there's more information on the website. There is my email address for anyone that wants to make contact. And I'll be back with you next Sunday. Cheers.